If everything around the world starts breaking at the same time, but one economy keeps standing strong, does that mean the entire global market can keep rising anyway? Hello, everyone, and welcome back. Before we get into today's deep dive, make sure you subscribe if you enjoy clear documentary-style breakdowns of global finance and macroeconomic trends. Right now, global markets are sitting inside one of the most unusual and concentrated financial environments we have seen in years. On the surface, everything looks almost deceptively stable, especially in the United States. Growth has not collapsed, employment has not fallen off a cliff, and corporate earnings have continued to surprise to the upside in several key sectors. But underneath that stability is a far more sensitive structure than most investors realize. The dominant narrative shaping markets today is simple on the surface but powerful in its implications. As long as the U.S. economy looks stable, and as long as corporate profits continue to hold up, risk assets like stocks can keep moving higher even if other parts of the world are struggling. It's almost like a global financial anchor has formed around one central point. Investors are no longer evaluating all regions equally. Instead, they are heavily weighting one factor above everything else: the resilience of the U.S. economy. To understand this mindset, imagine a massive city at night. Different neighborhoods are experiencing different levels of activity. Some areas are quiet, some are under pressure, and some are clearly slowing down. But one district in the center remains bright, active, and expanding. In that situation, most capital, attention, and confidence naturally flows toward that one strong district. That is essentially what is happening with the U.S. economy in global financial markets today. But this concentration of confidence comes with an important hidden condition. Markets are not just rewarding strength, they are rewarding stability relative to expectations. And expectations today are already very high. The U.S. economy has not been booming in a traditional sense. Instead, it has been moving in a narrow but stable range. Growth is not explosive, but it is positive. Inflation is not spiraling, but it is not completely gone either. The labor market is not overheating, but it is also not collapsing. It is a balancing act that creates the appearance of durability. This kind of environment often produces a very specific market reaction. Investors become comfortable enough to stay invested, but cautious enough to watch every new data point closely. That combination creates a market that can rise steadily, but is also extremely sensitive to surprises. One of the most important drivers behind this resilience has been corporate earnings, especially in large-cap U.S. companies. Even though the broader economy is growing at a moderate pace, many corporations have managed to maintain strong profitability. They have done this through a combination of cost control, productivity improvements, and most importantly, technological transformation. Artificial intelligence has become a major force in this story. It is not just a theme anymore. It is beginning to show up in actual financial results. Companies are using AI to automate processes, reduce operational costs, improve efficiency, and in some cases, unlock entirely new revenue streams. This has created a situation where earnings remain stronger than the underlying macro environment might suggest. In financial markets, this creates a powerful illusion of strength. When earnings are strong, investors often assume the broader economy must also be strong. But in reality, earnings can be influenced by structural changes in productivity that do not immediately reflect in traditional economic indicators. This divergence between economic growth and corporate profitability is one of the key reasons markets have remained resilient. It allows stock prices to be supported even when the macro picture is not particularly exciting. However, this kind of structure always carries a hidden tension. When markets rely heavily on earnings strength in a few sectors, especially technology-driven sectors, they become more vulnerable to any disappointment in those areas. It does not require a major crisis to disrupt this balance. Even a slight slowdown in earnings growth or a small increase in negative surprises can shift sentiment quickly. That is because expectations are already elevated. This is where investor psychology becomes extremely important. Markets are not just reacting to reality, they are reacting to the difference between reality and expectations. If reality meets expectations, markets stabilize. If reality exceeds expectations, markets rise. But if reality falls short, even slightly, markets react sharply. Right now, expectations are leaning on continued strength. That means the margin for error is becoming smaller. At the same time, the labor market in the United States is sending mixed signals. Employment is not collapsing, which is a positive sign for economic stability. But hiring momentum has cooled compared to earlier cycles. Wage growth is also moderating. This creates a situation where households are still employed, but the pace of economic acceleration is not strong enough to suggest a booming cycle. This kind of labor market is often described as stable but fragile. It supports consumption and prevents recession in the short term, but it does not generate strong growth momentum either. As long as layoffs remain contained, markets tend to interpret it as supportive. But any deterioration in job conditions can quickly change that perception. Inflation dynamics add another layer of complexity. While inflation has come down from its peak levels, it has not disappeared entirely. This means central banks remain cautious, and interest rates remain an important factor in shaping market liquidity and valuation. Higher interest rates tend to compress valuation multiples, especially in growth sectors. But so far, strong earnings have helped offset that pressure. This balance between interest rates and corporate performance is one of the key reasons markets have been able to hold their ground. Another major factor supporting U.S. markets is global capital flow. In times of uncertainty, capital tends to move toward assets and economies perceived as more stable, liquid, and innovative. The United States continues to attract a significant share of global investment for exactly these reasons. This inflow of capital reinforces market strength, creating a feedback loop. Strong markets attract more capital, and more capital supports higher markets. Feedback loops can also reverse if sentiment shifts, which is why they are closely watched by analysts. Now, while equities are reflecting optimism tied to earnings and innovation, another important asset class has been behaving differently. Gold. Gold has always held a unique position in global finance. It is not dependent on earnings, cash flow, or corporate performance. Instead, it is driven by trust, uncertainty, and long-term monetary concerns. Traditionally, gold performs well when investors are worried about inflation, currency stability, or systemic financial risk. For many years, gold has acted as a defensive anchor in portfolios. Investors typically bought it not because it was exciting, but because it was stable in uncertain times. It was the asset people turned to when confidence in other markets was weakening. However, recent market behavior has introduced a new layer to this story. Gold has not only been influenced by defensive demand, but also by momentum-driven buying. This shift is extremely important because it changes the character of the market. When an asset like gold becomes part of a momentum cycle, its price movements are no longer driven purely by fear or protection. Instead, they also begin to reflect speculative participation. In simple terms, more investors start buying gold not just because they are worried, but because they see its price rising and do not want to miss out on the trend. This creates a situation where two different groups of participants are active at the same time. Long-term investors are holding gold as protection against uncertainty. Short-term traders are entering because of price momentum, and both groups are contributing to upward pressure. But when momentum becomes too dominant in any asset, it can create instability. That is because momentum-driven buying often depends on continuous price increases. Once the pace slows, participants who entered late tend to exit quickly, which can amplify downside moves. This is why markets sometimes experience what appears to be a blow-off phase, where prices rise rapidly, attract attention, and then become vulnerable to sharp corrections. It is not necessarily about the long-term value of the asset changing, but about short-term positioning becoming stretched. Gold is now sitting in a phase where this dual identity is becoming more visible. On one side, it still carries its traditional role as a safe haven asset. On the other side, it is increasingly influenced by momentum behavior. That combination can create powerful rallies, but also unpredictable corrections. What makes this even more interesting is the contrast with equities. While stocks are being supported by strong earnings narratives and technological optimism, gold is reflecting a mix of caution and speculative enthusiasm. Both are responding to uncertainty, but in very different ways. This divergence tells us something important about the current market environment. Investors are not unified in their view of the world. Instead, they are split between confidence in growth and concern about long-term stability. In the background, there is always a risk that markets are becoming too comfortable with the current balance. When everything appears stable, risk often builds quietly beneath the surface. It does not show up immediately in price action, but it can become visible when a catalyst arrives. That catalyst could come from several sources: a slowdown in corporate earnings, weaker than expected economic data, shifts in interest rate expectations, or unexpected global shocks could all alter sentiment quickly. Markets do not need a major crisis to reprice. They only need a change in expectations. And that is the key point in the current environment. It is not just about how strong the economy is today. It is about how much strength is already priced in. When expectations are high, even good data can sometimes disappoint if it is not good enough. This is one of the most important and often misunderstood aspects of financial markets. Looking back at history, similar patterns have appeared before. During periods of technological transformation or strong innovation cycles, markets often become heavily concentrated in a few sectors. Eventually, those cycles either extend further than expected or correct sharply when expectations become too stretched. Today's environment has elements of both stability and fragility. Stability because the U.S. economy continues to perform in a relatively steady range. Fragility because market expectations have moved higher, and sensitivity to disappointment has increased. In the coming period, investors will likely continue focusing on a few critical indicators. Corporate earnings will remain central. Labor market strength will be closely watched. Inflation trends will continue to influence central bank decisions. And technological investment, especially around AI, will remain a key driver of sentiment. At the same time, gold will continue to act as a mirror reflecting investor psychology. When confidence rises, momentum may dominate. When uncertainty increases, defensive demand may return more strongly. Ultimately, the global financial system is not moving in a straight line. It moves in cycles shaped by confidence, fear, innovation, and adjustment. Right now, the system appears to be in a phase where confidence is still dominant, but sensitivity is quietly increasing underneath. And in markets like these, the most important thing is not just what is happening in the present moment, but how quickly the narrative can change when new information forces investors to rethink what they thought they already knew.